Good morning, good evening, wherever you may be watching this transmission. It is I, Mike Martins, bringing you a very special edition from a very undisclosed location. Heck, I'm just in Merritt. Welcome to Corner Market Watch. We got Andrew Baker here from Australia, from Sydney, Australia to be exact, who's been basically following the markets for, I guess, since he was 9 years old. So he's been following the markets for a long time now. He understands what's happening. He writes a lot of things out, takes notes, does well in the markets himself, and educated me quite a bit in the markets and teaching me just different aspects and different instead of, because I'm one of those investors that kind of go with a whim or gut feeling. Andrew's the guy that actually knows what's happening and understands what to look at and where to look at, what to keep away from, where to invest. We don't give financial advice here, and you guys know that, right? But it's good to talk about what's happening in the markets so people have some sort of an understanding on where things are headed, because it's all our futures that are tied into this world. Everybody, whether you don't invest or whether you're looking to invest or whether you've invested before or whether you are just a common citizen on this planet that wants to see us do well as a freaking human species. So, Mr. Baker, thank you for being on at such short notice.
Thanks for having me. Let's do this.
All right, buddy. So, Dow falls 508 points. Nasdaq turns negative for the year.
Yeah. So that's pretty much to be expected. Borrow rates have gone up quite a lot. Interest rates have gone up. The cost of refinancing existing debt is up a lot, so that's kind of to be expected. Most of the US market has been determined by share buybacks for the last probably 2 or 3 years.
Stop.
And that's because yeah, exactly.
Can you go back and explain because a lot of people are a lot of junior investors on the channel. Can you explain to us how the share buybacks work, basically how it's a shell or it shells out a company? Explain to us in basic terms what is... So
basically, what a share buyback is, whenever there's unallocated profit from that company for a given period between the last dividend issuance, they can either issue a dividend, which is from the profit that the company's generated, or they can buy back their own shares.
Okay.
But what they can also do is they can issue bonds that are lower, that have got a lower yield than some treasury. There's some corporate bonds in some instances that had lower yields than treasuries. So all they were doing was going and buying treasuries, issuing a bond and then buying treasuries, and then using the difference between the yield on the corporate bond and the yield on the treasury to then buy their own shares back.
So that's like robbing Peter to pay Paul.
Well, it's arbitrage. People call it arbitrage, but it's really just a gap between what people see as risky and what people see as less risky. So people were seeing some corporate bonds as being less risky than government bonds. Like Apple, for example, had a lower yield than the US Treasury at some point. Mm-hmm. So they could literally issue a corporate bond from Apple, then go and buy US Treasuries, and the gap between the two of them was just giving them free money, which is crazy. Like, they could borrow basically at zero rates. Now, the fact is, since the US has raised rates, there's been a bunch of times the US has raised rates. I think it's 4 times this year, or it'll be 4 times this month.
Right. And Canada will be 3 times this month. No, Canada will be 4 times this month too.
Yeah, so Canada was at 1% at the beginning of the year, I believe. They're at 1.75% now.
Yeah.
So they've raised 3 times. I think the US is in the same position, but they've risen from a lower. So the US had lower rates than Canada did, and they've risen more times. Right. So the US has started raising rates since 2015, and basically since the end of 2016, they've just risen a bunch of times. But it's been increased, so the frequency of rate rises has increased as we've come towards the end of what I believe is the market cycle. Okay. So going back to the share buybacks, they can't effectively buy shares by issuing corporate notes or bonds or whatever they want to issue to try and buy them back. So they have to try and rely on profits. And a lot of these companies, without that financial engineering, aren't profitable.
That's
right. So they can't actually buy their own shares back with profits because they're not making any profits. Now, the incentive for...
Hold on, Andrew. We got a pile of people in the comments asking that they want us to confirm that this is live. We have 3 minutes to confirm where they're going to jump off. Guys, we are live with Andrew Baker here from Sydney, Australia. This is live. This is not a replay. Have you seen this on my channel before? No, this is not a replay. This is live. So, guys, please, this is live. I have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 people in the comments asking the same question. Yes, we are live. Today is, I'll prove it to you.
What time is it? What time is it over in Canada? Just to confirm.
7:08 p.m. Today is December 17th, and it's December 18th for you.
Yeah, it's Tuesday. It's Tuesday 18th here at 2:08 p.m. So if you want to check that, then be my guest.
Yeah. And it is 7 p.m. here. So, anyways, okay. So stock buybacks continue.
So the reason why there's so many companies that are so keen to do these share buybacks is because the what's called short-term variable remuneration of the board of directors is calculated based on the total shareholder return. And total shareholder return is a combination of share price increase and dividend being paid. Right. So if you're not going to issue a dividend, the only way you can increase the total shareholder return is with the share buyback, because the share buyback pushes the share price up.
Right. And then when it pushes when it pushes the share price back up, it creates, to me, in my opinion, it's like a hollow shell, like a hollow.
Well, it's false demand. It's really what it is. All you're doing is decreasing the number of shares on float. So every time they do that, they're just decreasing the number of shares outstanding. And they do it all the time to try and make it look like the company's really liquid, even though they're not. It's just that there's a fewer number of shares outstanding. And as a percentage of the total number of shares, it's still relatively similar, or it's going down ever so slightly.
Yeah, I see where that's headed. Growth fears send the Russell 2000 into bear market.
Yeah, well, I think really it's been bear market since late September, really, because if you look at the volatility index, it was bottoming out around 11 in late August, early September, and then by the time the US had risen rates on the 26th of September, the volatility just spiked a few days later. So by when was it? It was like the 4th or the 5th of October, the VIX had gone from like 11 or 12 to 25, 26. So it basically doubled. The risk in the market, or the market price of risk, had doubled essentially in a few days. So and it hasn't really gone back down. So normally, if you look previously in this cycle, there's been a number of spikes, and then it will go back down, and then it will spike up again and go back down. But the last real spike where it's been as long as what it is now was back in 2015 when the Chinese stock market collapsed. And then before that, it was the European debt crisis. So there's a whole bunch of things now. We're basically seeing that, but there's no real, there hasn't been a big fall. There hasn't been some obvious thing that's happened. Okay. There's no European debt crisis. There's no Chinese stock market crisis. There's no, there's risks of things happening, but the outcome hasn't occurred yet, if that makes sense.
Okay, we got a question here from Oliver St. John. Is the VIX heavily manipulated?
Oh, absolutely it is. Of course it is. It was one of the most crowded trades up until about late January of this year. It was one of the most crowded trades. I think it was 92% of the market was short volatility. Now, the problem with that is it affects, because people are trading off the index, it affects what people are pricing in as risk on individual stocks, because the largest market cap stocks, so your Googles, your Apples, your Amazons, your Facebooks, all of these large market cap stocks, particularly tech stocks, because they're large in the US, a lot of those stocks were basically not pricing in risk at all.
Right.
right? Like by February and March of this year, you had Donald Trump talking about trade wars with China. You had Turkish lira was collapsing. You had a whole bunch of issues with the Italian
New
the
government.
Italian new government, Salvini. You've also had issues with
Venezuela.
Venezuela, I don't think is as big of an issue. Like it is an issue, but it's more on the periphery in terms of markets. Like they're a fairly closed market. Like that's part of the issue they have. The issue in Venezuela is that there's been such a large amount of inflation that basically the currency is not worth anything, and people. Well, obviously there's going to be civil unrest if you have to work a day for a cup of coffee. You know, like that happens. That's happened a bunch of times throughout history. It's not the worst example of it. Like Weimar Germany was worse, and pre-French Revolution France was worse. So, you know, it's worth knowing history to say which of these is the worst outcome. So, what exactly was the question again? You're asking about, like, what do you think the VIX? Do you think the VIX is heavily manipulated? Absolutely.
That was a question by Oliver St. John.
It is. Well, at least it was. I don't know that it's as easy to manipulate now that money's not as easy to access. Like US dollar liquidity has dried up heavily. So if you're going to talk about manipulation, it's more about the amount of liquidity in the market. So the manipulation would more be from the Federal Reserve in terms of setting interest rate policy. Okay. Because that's going to determine volatility. Volatility is if it's really cheap to borrow, then it's going to be very easy to just short volatility forever because the market will just keep going up because people just keep doing share buybacks until they can't borrow anymore. And when they can't borrow anymore, which is now, then volatility can't be as easily manipulated, and it'll be a lot less predictable than what it was in the past.
Well, this is what's happening. Because people can't secure money, they can't secure financing anymore to buy their homes.
No.
And this has gotten to a point where this is the first time in my opinion in human history, recorded human history, where a Sydneyer who lives in Sydney or a Vancouverite that lives in Vancouver that was born, raised, works a job like
it's not the first time. Like if you're talking about human history, it's not the first time. It's the first time
I'm talking about in our time in the last, like, let's say 100 years, okay?
Oh yeah, well
I'm talking about this is
last 100 years, yeah.
I'm talking about this is the first time where a person such as myself, with a very impressive income, living in Vancouver, or doctors and other people, they just don't want to buy. It's just too expensive.
It's the same as Sydney.
Either they can't afford to buy, they're bought out, and this is the first time where a Sydneyan proper, born and raised, educated, high-end job, can't afford to live in his own city, and they're migrating to Hobart and into other cheaper.
Well, the common one is Southeast Queensland. There's been a lot of moves to like Brisbane and the Gold Coast. Mm-hmm. There's a lot of moves there. There's not as much to Tasmania. Like, it has definitely been to Tasmania, but it's usually like middle income families, like people that want to raise children, but they don't have enough money to live in Sydney,
right?
Or Victoria.
But enough of those people have moved to Tasmania to actually manipulate the market, the housing market there. It's up like 18%.
Yeah. There's also been a lot of foreign money that's gone into Hobart, particularly like that 2015, 2016, when it became such a battle to try and buy in Sydney. There was a lot of money that then went to China, from China to Hobart. Like one of the big things with Hobart was that the Chinese president Xi Jinping went to Tasmania back in, I think, 2014 or 2015. And there's a lot of people in China are very, very much have a follower mentality in terms of where they'll put their money. Like if there's a rich celebrity, which is, I don't think that's unique to China. It's just if there's someone that's a celebrity, they'll say, oh, they've bought this in this particular place. Then all of a sudden there'll be a bunch of people that follow them with their capital will go there. I think there's also been an element of money laundering. I don't know. It's very difficult to say how much of it's money laundering because our banks don't really want to say anything. And if you do point it out, they're basically just going to sue you, put a gag order on you. So
yeah. Yeah, I just wanted to throw that in there because in British Columbia it was a billion. I think it was billions, to be really honest with you, was
Oh,
laundered
would be.
through
Yeah,
casinos. I mean, through
yeah,
casinos.
yeah,
So that somebody would walk in there with a hockey bag, no hand to God, with a hockey bag full
yeah,
of money, and you know how big hockey bags are, right?
yeah, yeah,
They walk in with a hockey bag, buy $5 million in chips, take the chips, those lavender chips, sit at the table, let spend a couple hours, have a few drinks, flirt with some women, take it back, cash it in, and it's crystal clear. And that's
yeah.
happened. It's been happening in BC casinos, I think, for the
For a long
last
time.
20 years now.
Yeah, but I think again, that sort of thing. That sounds like Mexican drug lords trying to go through HSBC to get their money out of
And Wells Fargo.
Yeah, exactly.
Yeah.
Um, it's probably the fentanyl issue that you've had in Vancouver and Toronto. It's probably part of that has
Mm-hmm.
gone through those casinos. Like, I'm not going to say for sure what it is because I don't know, but sounds like it.
Yeah. Okay, so I got something else on the corner market watch here. Crypto bounce heartens true believers waiting for market to bottom. What's going on?
I don't really. To be honest, I haven't been paying that much attention to crypto markets. Like, um, it's very. You hear these stories about, oh, crypto is going to bottom out. It's going to bottom out. I don't think it will bottom out until after everything else in every other market bottoms out as well, or it'll happen roughly at the same time because a lot of the crypto market was based on how much people were borrowing and then buying um, cryptocurrencies. So it wasn't necessarily to do with any fundamentals whatsoever. It was just the extent to which people could borrow. Again, the extent to which people could borrow to buy cryptocurrencies. Like there's stories of people going out and getting $200,000 home equity lines of credit to then buy Bitcoin at 8 or 9 thousand US dollars, and they made their money, but if they didn't get out in time, then they've lost a lot.
Yeah.
So
No, I hear you. I hear you. I have somebody actually sending me a message here through Skype for you.
yeah,
What is the mistake that people commonly likely to make during a volatility market?
I think the biggest mistake people make is thinking that volatility is somehow a sign of the bottom of the market.
Okay.
If you need to know that there's still going to be credit available once volatility goes back down. That's so in 2015, there was no intention of interest rates being risen, so there was still the capability of getting out of it. And Janet Yellen, who was in charge of the US Fed, basically said, well, we're going to keep putting quantitative easing in the market. So even if it does look like it's going to go down, we'll just keep doing this. So it doesn't really make a difference.
So do you think we're in QE infinity right now?
I don't think so. No, I think you're going to have a point where they realize that QE causes issues that aren't necessarily monetary. So you'll have a lot of social cohesion issues, which you're seeing in France for sure. I think a lot of that mentality is also present in places like Australia, Canada, New Zealand, the US. A lot of English-speaking nations have got that issue because there's such a large amount of wealth inequality. Mm-hmm. There's people that have got debts they know they're never going to pay off, or there's people that have been locked out of markets because they're so beyond what they can ever service.
That's cool. Okay, that's good. Okay, I have another question here from Alex Oakley, who is a trader on Wall Street. And his question is, people on Wall Street this last couple of weeks on the trading floor have been saying, forecasters have been saying, they may see the bull market stretching to one more year. What do you think?
It's possible. I mean, it's possible, but it's a question of there needs to be a lot of things that go right. Like you need China to make sure. You basically need the US China trade issues to be resolved, and you also need there to be not high enough inflation that rates have to go up further. That's so you basically need to really tread this really fine line between having accommodative monetary policy and having a trade situation where there's still robust growth without inflation. So it's very difficult to achieve that those sets of circumstances simultaneously.
Okay.
That's basically what I see. Like it could, but it's very unlikely. Like the U.S. corporate debt is higher now than what it was prior to the GFC. So there's been a shift from households taking on the debt to households and consumers taking on the debt to the corporate sector taking on the debt, which is why the equity prices of banks hasn't risen at the same rate as what your Wayfairs, your Netflix, your Googles, your Amazons have risen, because they've taken on more debt than what consumers have. Well, the consumers basically can't, because in the GFC they were basically bankrupted. So
okay,
that's my thought process. Like, again, I could be wrong, but I think it's interesting to hear other people's perspective.
We're just talking, dude. We're not writing this in stone. We're just having a conversation, you know? Okay, I got a question here from Palm Springs from Unknown. It's a question for Andrew saying, what are several things that need to happen for the stock market to bottom?
Well, for it to bottom, that's a really good question, actually. So you need to know that it's topped before you can say where it's going to bottom. I'm pretty sure that it topped out in August of this year, if you're talking about Dow and S&P 500 constituents. But that's been happening for a longer time than what the market has been indicating. So the ratings, one of the good ones is like, in terms of particular indicators, there's the GWIM cash allocation, which Bank of America puts out.
Right.
So if you look in the GFC or in GFC times, when the bailout came in, the cash allocation of the equity market, so money market accounts, was like 20 or 21%. When the market was topping out, it was 11%. So basically, double the cash allocation. So the more cash you have on hand to buy equities, the closer you are to the bottom of the market. It's very difficult to say exactly what the bottom is, but you can combine a couple of factors. You can combine the rate of change of credit. So if your consumer credit and corporate credit start going back up, then that's probably a likely sign of the bottom of the market. So if there's a big drop in credit supply, and then all of a sudden it returns. So if you get more lenient lending policies or more accommodative interest rates. So if interest rates start going back down and they bottom out, then that's kind of a good indication. So that's one of them. The GWIM cash allocation is a really good one. For bottoming, there's also things like the gap between the average hourly wage growth and unemployment rate. So when there's a large gap in that and it starts shrinking, you're at the bottom of the market. So if wage growth is zero or negative and you have high unemployment and it starts trending downwards, but it's still, that's just showing you that credit is returning to the market, because you can look at things like there's a really good chart between the relationship between the change in credit and unemployment in both the US and Spain. Because if you look at how they perform, it's almost a one-to-one relationship. So the more credit there is in supply, the lower unemployment is going to be, because it's easier to borrow to then put that money that you borrowed into payroll to paying staff.
But you're borrowing to consume, right? And that's the scary part. Is a lot
but
of
I think that's what our economies are based on. Like, we haven't been industrial economies for the last, basically since 1982, really.
Well, what's scaring me is that all these countries, especially Canada's like the torchlight of to be green. We're going to close everything down here, and we're going to be the torchlight and show the rest of the world that Canada can function normally.
But there's no incentive to invest in green energy, though. There's no, like, in terms of financial instruments that exist, there's a thing called, you've got sustainable metrics and you've got green bonds, but that never gets, so whenever you hear debate between conservatives and liberals, right, like people that are either for or against renewable energy, like that debate that happens, not once do people talk about how you, like, so they say, oh, how we're going to fund this, or it's going to be so unprofitable for us to invest in this, it's so expensive, etc., the capital outlay. But there's no talk about, well, green energy bonds can be issued at this rate, so you can have private sector investing in a government infrastructure project, like, so you can still get a return out of this investment, but like we'll front the infrastructure spend, but we'll also give you an opportunity to invest in it. So yeah, there's not that conversation hasn't really happened, or it's not advanced to the point where the public can actually see where, like, everyone says how we're going to fund this. There's not really been a discussion about that. It's more about throwing stones from either side about, oh, you know, climate change is bad, or we should be using this type of technology. But there's never a talk about how do you pay for this.
Yes, no one's discussing the financing behind it, right?
No.
Who's financing this? Okay, I got a really good question here for you from Rainier Mola. Question is, if you're saving liquid cash for a big investment after a recession, would you save it in gold, U.S. or Canadian dollars? Gold or Canada or U.S. dollars?
That's a hard question. Well, gold is primarily to protect against inflation, right?
Right.
And the biggest issue in economies like Canada, Australia, and the US is that with high private debt, that's a really deflationary force. So you would say that gold is probably not going to hold up that well if you go into recession, because it's likely to be a deflationary recession. If you're in Venezuela, though, if you're in like emerging markets economies, where a large amount of your borrowing is in, well, if you're in South America, a large amount of your borrowing is in renminbi, or your borrowing is in US dollars, then you have to pay back the US dollars. And if you're in a situation where your dollar keeps losing its value, you go into this spiral of high inflation because you're trying to pay back debt, and to pay back the debt you have to borrow, and then it keeps spiraling, so to the point where you get really high inflation. In that situation, gold does well. So if you were in Venezuela and you had gold, you'd basically be, so if you had gold from, you know, back in 2012 and you'd held on to it and you looked at your currency and then looked at the US dollar and looked at your gold, you'd be like, oh my God, I've made so much money. But it's all relative to what your currency is doing. So their currency is highly inflationary. Whereas, like, if you looked at Japan, for example, they haven't had inflation since 95. So it's not as cut and dry as being like, where should I put my money? It's a question of, first of all, how much stock of money do you have? If there is a high amount of inflation, it's worth having a percentage in gold, or a percentage in silver, or a precious metal that you think is going to retain its value. But again, is that going to be?
It's a good hedge.
It's a hedge, because basically you're trying to figure out, is there going to be inflation or is there going to be deflation? Because one way or the other, there's going to be a large amount of it one way or the other, really. And I don't think you're going to lose purchasing power by having cash, because cash, especially US dollars, the amount of cash that you need when interest rates start going up becomes more and more and more, to the point where if you do have that and no one else has got it, they're willing to sell you things for a lot less. So you end up in a position where you can pay a lot less for things with the same amount of money that you had.
Okay, I got another question here from, Rainier Mola has a follow-up question. So gold is good in inflationary market, whereas in Canada and the United States, we may have an upcoming deflationary market due to high corporate debt?
Yes, exactly. Because part of the inflation occurs, like everyone says, oh, but there's low inflation, right? There isn't low inflation. There's high inflation, but it's just not being recorded because it's in asset markets. It's in housing and stocks. So there is inflation. It's just that the way that we record it is a really naive way of understanding what inflation is. because you still need to pay, like, especially in Canada and Australia, you still need to buy a house to live somewhere, or you need to rent somewhere to live somewhere. And both rent and house prices would be tracking much higher than what inflation would be, right?
Okay.
Like everything else is, like food, for example, would be either deflationary or flat. But when all of your money goes towards debt service, it has to be the case that everything else is in deflation. But when that drops, everything's in deflation, right?
Yeah.
So when the asset market drops, everything's in deflation. It's just a more severe case of deflation.
Yeah, especially if this housing market starts to crash, and a lot of people borrowing off their houses through HELOCs.
Yeah, exactly. A lot of people, when I hear the debate about, a 0.5% increase in rates in Australia is not going to make that much of a difference. It's like, well, yeah, it will.
Yeah, it will.
Because 60% of all loans are in housing, and $7.2 trillion worth of equity in Australia is in the housing market. So if you lose 10% off the top, that's like, 30-40% worth of GDP you've lost in equity in one go. So that's a pretty big crimp on purchasing power, and I don't think people fully understand the extent to which that's going to affect people, because a lot of people have been borrowing against the house, and it's not well recorded. Like, you don't have a ledger that's saying this is how much people have borrowed against the house, or this is how much equity someone's taken out of the house so their kids can buy a house.
Right.
Like, they don't have a well defined metric for how much of that has been borrowed. Like, cash purchases, there's obviously going to be, it's much easier to record because it's just paid cash. Like, with a mortgage where it's just a cash deposit and they've got a loan, it's much easier to record. But when it starts coming out of people's equity from another house, or there's cross-collateralization, it's very difficult to figure out where exactly the root is of where that money's going to have to come from. Because if they all go at the same time, like, what do you do then?
No, but you see, Andrew, this is my opinion. I think it's going towards expensive vacations, fur coats, second, third cars.
Oh yeah, there's definitely discretionary consumer expenditure going on for sure. Like, people were spending on, like Uber Eats, Deliveroo, getting meals delivered to their house, and especially in urban areas. There's a lot of that. There's also, like, there is holidays. There's Netflix, your Stans, or Stan in Australia, like Hulu and Amazon, all those sorts of things. There's definitely expenditure there. Like, we have a thing in Australia called Afterpay, which is where you can just borrow and then pay back without interest over a series of installments.
There was a bunch of furniture companies here in Canada scamming people. Don't pay a cent for 4 years, and then if you don't end up paying it back by then, they load you up with front-loaded interest. And
it's basically, well, to me, it's like delayed payday loans, really, because that's basically what it is with those kinds of, like, no interest for 4-year loans that are given out, because the interest payment, once you miss the payment, is like 20%, 25%.
Man, the mafia doesn't even charge that much.
Well, you're never going to get that back. It's serious lending, which, if the people that are doing the lending realize, like, if they're of any religious belief whatsoever, then they're doing things that are against their own teachings. So,
Okay, we got Canadian has a question here from Canadian. Says, does North America have more inflation than Europe?
Absolutely, it does, for sure. Yeah, Europe is being deflationary, really. Like, in terms of incomes, if you look at incomes after inflation, they've had negative real wage growth for a really long period of time. Whereas in the US, the inflation now is 3.5%. In Europe, they're struggling to get 1 or 2%. Like, in Germany, I think it's 1.8%.
No, yeah, 1.85, yeah, almost 1.9. Yeah,
that's like their best market. Like, save maybe, I don't know, maybe Estonia or something like that's going all right. Or there's like Poland. Poland's going all right.
Yeah. Poland's always been doing right because they try to segregate themselves from the EU.
They don't have very high personal debt, and their government debt's quite low as well. They also have a young population, so they have a lot of demographic and macro trends going in their favor. They don't just have, like, when you start looking at UK, Spain, France, Portugal, all these places. Like Spain's median age is what, like 40 or something like that. France is also 40. Germany is almost 50. And they had really high private debt up until the end of the GFC, and they're not going to be able to get the same amount of private debt now because, first of all, their population is declining. Like all the people from Spain that were in Spain, they had a bunch of people that were from Poland that went to Spain to do construction work, and then they went back to Poland with all the savings they'd made because they couldn't work in Spain anymore. No one was lending money, so therefore there weren't any construction jobs. Whereas the Spanish have left with the debt, or the German investors that have invested in Spain, or the British investors that have invested in Spain, are left with the debt, and they can't get jobs. So basically, there's been a whole deluge of people from Spain going into the UK to try and get a job.
Yeah, I remember that. Especially, do you remember when they went in hyperinflation mode when it went to building housing and summer retreats, and they were advertising it all over the world?
Well, it was Southern Europe basically, like your Greece. They call it pigs countries, which I don't really like the term, but Portugal, Italy, Greece, and Spain, they were the countries that had a large amount of foreign investment. But to me, the most obvious reason for that being the case is because the entire European Union that uses the euro can basically just arbitrage off differences in inflation. Like if you've got 5% inflation in Spain and there's 2% in Germany, then it costs more to borrow in Spain than what it does to borrow in Germany. So therefore, you just lend to Spain because they have to pay a high interest rate, and you're getting paid back in the same currency. So, it's obviously there's ways to get around it. Obviously, you're taking on a lot of risk by doing it, and I don't think people fully understood that because they have a bunch of political limitations. They have political limitations on what they can do in their economy, but all the political limitations are on government. None of it's on the private sector. Like one of the biggest issues in France at the moment is that fuel tax and all of these other excises to try and make sure that their budget stays within the Maastricht Treaty guidelines, which is you can't have government debt higher than 60%, which is garbage because they all have government debt higher than that. And you can't run a government deficit higher than 2%. Now, the Italians had their budget rejected for having a government deficit of 2.4% in the fiscal year.
That's right.
The French are at 3.6%, so they've got to try and cut down their budget by 1.6% to fall within the Maastricht Treaty guidelines. And to do that, they've basically pushed austerity on poor people, and the people don't like it, so therefore they're revolting. Like this is a completely financial situation that could have been avoided very easily by actually understanding where the issues lie in their own economy. And it's not just in the government.
The problem with the EU and why it was set up as a total failure is because they carpet blanketed the whole continent and expected every country to be at pretty much the same. They're
not homogenous economies, and you've given them homogenous interest rate of monetary policy.
That's right.
A homogenous economy, a homogenous currency. Like people talk about, oh yeah, but we don't have any trade barriers. You should have trade barriers. You think the Spanish are going to match the Germans for car manufacturing output? No, you're not comparing apples with apples. Like one is predominantly an economy that exports, goods into like wine. They're not producing the same level of complexity. There's not the same level of value add in the things that they export. So you're not comparing apples to apples when you look at having trade, because there's obviously going to be trade going one way because people always need a car. You can decide whether, like, it's a much less discretionary expenditure than what buying wine or balsamic vinegar is. Like they're not the same thing whatsoever. So this whole idea of, we need free trade because if we don't have free trade, all of our costs of goods is going to go up. It's like, well, no. It means that you just decimate whatever domestic producer of a good that you're then going to import from somewhere that's doing it better is going to. So basically, you're just getting whatever the best of something is, or the cheapest to produce. You're getting it wherever it's the cheapest to produce, which is why if you don't have any trade barriers to China, your manufacturing sector in your own economy is going to get decimated. And people say, oh, yeah, but it makes it cheaper for people. Yeah, but what's the point of it being cheap for people if they can't get a job?
Yeah,
right?
yeah, of course.
So
Yeah, of course. And then
that's
that pushes, yeah, we're not going to get into whole migration patterns right now of Europeans, but I want to ask, I got a question here from Johnson and Johnson employee for 30 years now and a stockholder for 30 years saying
yeah,
that $5 billion share buyback program
yeah.
after report wipes out 50 billion in market value.
Yeah,
So
that was the whole what was they had asbestos in the baby powder,
that's
right?
right, and they're
And continued
denying the
exposure caused
allegations.
cancer.
Apparently, according to the message here, Johnson and Johnson denying allegations. So this is coming from someone that actually
They're not
works
going
for
to
the
be able to
company.
deny it. They're not going to be able to deny allegations because it's something you can empirically test for. It's very easy to test for asbestos or asbestos-like particles. That they have a very recognizable microscopic appearance. So if they're protesting that this is the case, then they could do a sample test of however many thousands of talcum powder, um, baby formula bottles,
Hmm.
and if they find that the representative sample has a certain amount of asbestos in it, then they can say, well, you basically have this mixed with your product, and if you're denying it, then you're denying empirical science, right? So it's very difficult to kind of say that that's not the case.
Okay. Um, just looking at, there's a lot of, I got questions here coming in on Skype. I got questions in our, I'm just looking at the questions here on the right side. I got questions coming from even in my email and people messaging me on Facebook at the same time. So I'm trying to do my best here, Andrew, to
Yeah,
kind of look at these 7 things on the side going while making sure we have a good continuity of discussion here. Uh, okay, so I have one here from someone from another person from New York. Wow, what time is it there? It's like almost midnight there. Okay, Andrew, what do you think of normalizing monetary policy and fears over rising leverage loan risk and geopolitical uncertainty?
leverage loan. Well, leverage loan risk is basically your your lower quality, so junk bonds, so the number of companies that have become junk bonds.
Right.
I think that's a massive issue. Of course, if US dollar liquidity dries up, then there's obviously going to be a bunch of bonds that are in existence that basically have to get downgraded. Um, so yeah, that's a massive risk to the US economy. What was the next part of the question? So that was the last bit.
Okay, hold on. Let me open it again. I just closed the window. Hold on. 1 second. Just be patient here. I got cha 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 cha. Talking. They're asking about normalizing monetary policy, and
Yeah,
we have a bunch of fears over rising leverage loan risks, and
yeah.
geopolitical uncertainty are all to blame. What do you think, Andrew?
I think geopolitical uncertainty is a result of previous monetary policy or monetary decisions. So decisions that were made 20, 30 years ago have resulted in the situation that we're in now. Because the biggest reason for the geopolitical uncertainty, especially like if not just in America but in Europe as well, is based on the fact that they have such a high amount of private debt. They have all these restrictions on their economy, and there's free trade. So you're obviously going to go to whatever the lowest common denominator is, and the lowest common denominator is where you can get the cheapest labor, and that's Southeast Asia at the moment. In the next 30 years or so, it'll be Africa after that. So
Yeah.
that kind of, that's that sort of issue that where you're talking about geopolitical risk. Yeah, this has been an issue in the making for the last 30 years because your labor force is going to change based on how much debt they have and what their propensity to be able to borrow to service their cost of living is. And if you can't borrow anymore, then obviously there's going to be geopolitical uncertainty. Like when you start looking progressively, there's a lot of money lost by people in the dot-com bubble
Oh,
And then there was even more money lost by people in the GFC or in the Great Recession, right? So to move from even in the 87 crisis, there were the savings and loans crisis, a lot of people lost money in that as well. So you start looking at bigger and bigger crises, and you have to borrow more and more each time to just be able to service your cost of living. So eventually it gets to a point where you never can service your cost of living. You've got into 50 years of your life and you don't have enough savings for your retirement. That's where geopolitical instability is coming from.
right.
It's not coming from, oh, we don't want to trade with China, but it's the reason why. You need to look at why that's the case. It's not just a question of, like, it's not just a question of, oh, we don't like these people or they're beating us on trade. It's a question of, why are they capable of doing that? Is it a issue with the capital system they have? Is it an issue with their labor force? Is it an issue like you need to break it down to figure out what exactly the issue is. It's not like the monetary policy is a symptom of a failure in economic understanding or a failure of economics bringing together a bunch of different things that are contributors to market forces. Like if you're only ever focused on government deficits and you're saying, well, we can't run a budget deficit, we need to run this. Like our government's announcing a $9.1 billion budget surplus in the next MyEFO, which is stupid, really. Like you're looking at, in my country, we have the second highest household debt to GDP in the OECD behind Switzerland, and we're the highest household debt. Like it doesn't make sense to do that because you would think, like, what's the bigger issue? Is it government debt or is it household debt? Like, obviously, it's a household debt because it's a much larger. It's a much larger debt.
We've been arguing this household debt thing for I don't know how many years now, and okay, I would say Australia's first because I think what's Switzerland's population? 6 million, 5 million. I think Australia would be
very large, and also Switzerland has a very diverse economy.
Yeah,
like so, when you start looking at Australia, our economic complexity is really three things: coal, iron ore, and housing. Like when you start going beyond that, you just get really granular. They're just the big three things, and they always have been. Like in terms of domestic economy, it's all services, but the services they always and if you follow the money, it always ends back at house prices. So
okay, I got a question here. Okay, but this is a really tough one for me to read because there's I'm not the best reader and there's got a lot of spelling mistakes in it, and it was sent through. It was sent through someone from mainland China.
Yep.
Okay. And before we kick off the question, before this person has sent me stuff before, in mainland China, and people are being rounded up that are actually leaking Chinese information, whether it is through Skype or Facebook or whatever means. And that's what I've been hearing through the grapevine. But we're not going to speculate into that right now, but this is it right here. China is going to invest and prop up Hong Kong's property market in 2019. And buyers from mainland China, okay, I think he says obtaining permanent residency status in Hong Kong next year will also support the market and drive up prices. This is insider information, please.
I don't know if that's true. See, you fundamentally you still need to be able to borrow, and a large amount of the Chinese investment market is based on shadow banks.
Okay.
Right? Like you need to look at, they'll say, oh, this is what the headline rate is. It's 3% interest rates, or they're paying 5% interest rates. But when it comes to actually looking at the entire market, how much of the market is being reflected by what they say is occurring versus what is actually occurring. Like if you look in places like tier 2, tier 3 cities, a lot of the lending that's gone on there has been basically usurious. Like a lot of the loans that have been issued there are to people that are either illiterate or don't have a whole lot of money, and they've been given interest rates of 13 to 15%. So the idea that they're going to be able to prop up a market where that's the case, they might be able to prop up capital cities, but they're not going to prop up the entire country because
I got
they
Mr. E.
don't
I
have
got
the capacity
Mr.
to
E.
do so.
He's our truth analyst for the channel. I think you know Mr. E. He's saying he's in Hong Kong right now, And he's saying
Yeah.
they sure are. They are clamping down big time. And then Mr. E says he isn't factoring in the triad discounts. Lots of loan sharking.
Yeah. There's a lot of that going on, like that whole uh, shadow banking market that's occurring, and I don't think that's really like I only really got that understanding by going to Hong Kong myself and speaking to people. Like you don't really get the full sense of what's going on the ground unless you go there and ask people what's going on, because there's obviously going to be some people that say, oh, we're going to toe the party line and say this is what we have to say. But there'll be a percentage of people that are happy to tell you, as long as you don't say who they are. Like, as long as there's an anonymity, they'll tell you exactly what's going on.
So I got a question here from someone from South Carolina,
Yeah.
and he's basically saying stocks are in a bear market, and it's become an emotional onslaught for me and my family. Should I just sell what I can and not hope for I just walk away while I can? Sorry.
See, that's a really hard question. I think, first of all, it depends on how much of your money is in the market. And second of all, it depends on how much of that money you need for day-to-day living. And third of all, how much more money you have left to lose. Like I would say if you're in a situation where it's going to be life and death, whether you lose money from this situation. Again, this is not financial advice. This is just what I would do. You've got to be in a situation where if you can't afford to lose the money that's in the market, I would be out. I would not be sticking around because there's a lot more downside than upside, and anyone that tells you otherwise has either got a financial interest in there being an upside in the market, or they're basically trying to offload what they can while they can by talking the market up.
Mm-hmm.
Basically, is my outlook. I like it could go up, but there's not very much upside. Like all the risks are to the downside at the moment. Like there's no intent from the government to say we're going to step in and print money. Like there has been a little bit of that in Canada, but it's not in the US. Like Jerome Powell basically has said, I'm just going to keep raising rates. Well, the inference has been, I'm just going to keep raising rates until we go into recession. That's what the inference has been from my perspective of what he's been doing. Mm-hmm. And I'm sure that's probably what a lot of people on Wall Street would expect as well.
Okay. So, guys, if you're just tuning in now, we're approaching our first hour on the show. We got Andrew Baker here, a really good economist on every front, understanding different markets, patterns, dips, equity volatilities, anything you want to eat, from ETFs to just dividends and anything you need to know in the markets. Andrew's a really good discussion piece when it comes to knowing anything in the markets, and he's starting up his new channel. So tell us, Andrew, when are you going to get this channel rolling for us?
So originally I was going to do it. I think I wanted to do it in October of this year, really, but there's been a bunch of issues that I've come into recently, so it'll probably be early next year, January, February. Just because we're too close to Christmas now to try and get myself and the people I was going to do it with together at the same time. But yeah, so I've got all the equipment ready. It's just a question of fleshing out what exactly we want to cover and the way that we're going to approach it. Initially, I just want to do it for free. Have it as like a channel that's just us basically putting our brains on a page or in a video and explaining what exactly it is that we do. The best thing I've found is for general public interest is like melding history and economics together. That's a really good one. Like understanding the foundations of like Judaism, Christianity, looking into French Revolution, the American Revolution, South America, how that was basically, the place of intelligence, or there was technology that came out of there. So I think it's looking at where money has been over time, and then explaining what the analogs to that are
Right.
at the present. So you can. So obviously that'll be part of the channel, but it's just a question of how we go about doing that. And then we might do tangents where we talk about what's happening in the market at the moment. But yeah, I think the focus is primarily about getting all the information together and then making sure, because if you want to talk about it, you can't just say, this is our opinion on what's happened, and then leave it at that. Like, I'm not the kind of person to just say, oh, I think this is the case, and not have anything to back up my argument. Like, I need to know pretty thoroughly. Like, I'll spend probably 2 or 3 months doing research on one topic before I start arguing a point.
Right. So you're a man of your word. So you actually want to make sure you got all the
saying the right
before
thing.
before
exactly.
you build that house, you want to make sure you got everything before.
Exactly.
You don't want to be left without a roof.
Well, you don't want to employ an electrician to do your plumbing, right?
Right. No, I know what you're saying. I know what you're saying. But once in a blue moon, I know I'm just a sack of dead weight. But you can have me on once in a blue moon just to say hi.
No, but I think you undervalue yourself a lot. You get a lot of different voices together, and you basically are able to put together this opinion based on what you've heard from a bunch of different people and try and figure out whether or not they know what they're talking about, first of all, and second of all, whether or not you're getting a sample of what reflects what's happening in the marketplace, or whether you're getting someone that's just going to talk out of their ass, basically. Like, there's a bunch of times where I've talked to people, and I thought, because I talked to a bunch of different people and they all gave me the same thing, I thought, oh, okay, this is the way it must be. And then I talked to one person and they said something that's completely 180.
Right.
And then they introduced me to a bunch of people that also thought the opposite way. And I was like, well, okay, there's got to be some middle ground here. Where does it exactly sit?
Right. So it's okay. I got a question here from another one. It's from Times. He says, I could see Madison Square Garden from my window.
Okay, cool.
Okay, he says, is the bond market telling us the stock market train wreck is almost over?
I don't think so, no. I think the thing we should be looking at, so people say bond market train wreck, but what do you quantify as a bond market train wreck? Is it a train wreck when you get to 25%? Is it a train wreck when you get to 50%? Like, what do you, like, where on the spectrum is the end? I don't think we're at the end yet at all, because there's a bunch of global issues that haven't played out. Like, China hasn't collapsed yet, which it will eventually. It hasn't collapsed yet. The US economy hasn't gone into recession yet. It will. There's a handful of countries in the world that have gone more than 25 years without a recession. Australia is the longest in the world. So the chances of us going into recession at the moment are very high. You have people that basically don't understand that government debt, private debt, and trade surpluses are the ways that you grow an economy. So if you're trying to run a surplus, then you're relying more so on trade surpluses and private debt, or net inflows of capital, net inflows of money. Now, if you're private sector, if you've made it so that it's very difficult to get loans in the private sector, then the only way you can grow your economy, if you're trying to run both a government surplus and a private debt is contracting because it's harder to get a loan, then you have to be running a trade surplus. Otherwise, you're in recession. There's no other way to go about it. Like, you have to be exporting, whether it's you have a net inflow of capital, so people are doing direct foreign investment, or whether it's people buying capital goods from the country. You need that net money to be coming in, otherwise you're going to go in recession. And that's basically what Germany's been doing. Like, they've reduced their government and private debt by running a massive trade surplus at 8% of GDP a year.
Yeah.
When all those other countries that import goods from Germany eventually can't do that, they have to flip their economy around in some way to be able to run what they've been doing now. So they either have to increase their government debt, or they have to increase lending in the private sector. So back to the bond issue, I don't think that looking at bonds and saying, oh, there's been this many downgrades, therefore it's the bottom of the market. Like, valuations are still very high. Like, if you look at Cape Shiller and the Robert Shiller cyclically adjusted price to earnings. If you look at Warren Buffett's market cap to GDP, they're all highly, highly elevated. Like they all say there's a lot of downside to equities and not much upside. Like once you start getting to 105, 110% of GDP in your equity market, where do you go from there? Like all your money's there for 1 year. Like, like in Australia, our housing market was like 400% of GDP in market capitalization, which is just stupid. Like I don't think I've ever seen that anywhere else in the world, not for a long time anyway.
No. And that's why I've been covering the Sydney, especially the Sydney housing market for.
Well, Sydney and Melbourne is like, what is it, like 2.2 times GDP just in those two markets?
Mm-hmm.
Stupid. Like that's like $4 or $5 trillion worth of housing value or equity supposedly is in those two cities. It's just stupid. Like, so say it's like $4.4 trillion, and say they lose 10%, then you're losing like 20% of GDP in equity, like that. It's just crazy.
Okay, I got a question here from London.
Yeah.
Okay, stating here to ask you, I have noticed overseas investors. He is a real estate agent. He's saying that he's noticed and witnessed lots of overseas foreign investors leaving the UK property market in big droves. Are you witnessing this also in Australia? I have also heard rumors that in New Zealand, a lot of foreign investors have retreated for the market. Is it a tougher?
Definitely.
Okay, so you're noticing that there, because in London he's saying that basically he's noticing, and he's a real estate agent. So according to what he's written a lot here, I'm not going to read the whole thing. It'll take me 40 minutes. But what he's saying here is basically that he's seen a big retreat, and that it accounted for about 14.4% of the country's I guess sales in housing.
Yeah.
So in London,
when you start looking at our apartment market, it was like 70-80% Chinese investors. You'd be lucky to get 20% now. So that it's definitely made a huge difference. Like, but I think people are assuming that it's a domestic thing here, and they'd probably be assuming that it's a domestic thing overseas as well, and that it's not a global lack of liquidity that's causing this issue. Like,
so I got a question.
With that question, does he know much about interbank lending? So LIBOR, bank swap?
I don't think so. This guy's I'm not trying to offend the guy, but he's just a real estate. He works real estate, right? So
okay, so that's one of the big things I'd be looking at. The LIBOR borrow rate, especially if they're getting money from. So if there's lending going on at like a small time broker, a lot of their liquidity has to come from the securitization market, or it's coming from foreign banks, right? So, or it's coming from a domestic bank who's then borrowing from a foreign bank. And if the domestic bank isn't going to lend itself, it's definitely not going to lend to a smaller bank. A lot of the times you'll also find that there's gaps in the documentation of foreign borrowers. So a lot of the foreign borrowers are either bringing capital in from another country to then buy cash, or they're bringing foreign. They're trying to take money out of another country to then put it in, to park it in property.
Okay,
you'd find that there's another thing which isn't really talked about, is there's a memorandum of understanding between the Chinese Anti-Money Laundering Commission, which is CAMELMAC. I can't remember what the exact words are.
Is this just in the United Kingdom, or is this?
No, it's within all the Five Eyes nations. So it's in New Zealand, United Kingdom, United States, Australia, and Canada. Okay. They all have a memorandum of understanding with China regarding money flows. So if there is money being laundered, they basically have to report it, and that wasn't the case even 2 years ago. Like it came into effect, I think it was like mid to late. It would have been like November 2016 it came into place. Not a lot of people know about that, but it's something that definitely influences that money flow.
Right.
Okay. Much harder to. launder your money that way.
Okay, the buddy here from Welland, New Zealand, saying, "Goodbye bidding wars. It looks like some of the hottest housing markets here in New Zealand have definitely cooled off, and no bidding wars. Bidding wars look like they are a thing of the past." Thank you, Mike, for your channel, and thank you, Andrew, for being on.
Oh, thank you.
Are we seeing a goodbye to this whole bidding war? Because when I was
younger,
the
bidding wars are gone. The bidding wars are gone.
Yeah, when I was younger, if I wanted to buy a house, for example, like this house here in Merritt wasn't high demand. No one cared. I sent out an inspector. We saw the property, and then I sent out.
They were off. What do you call it? The private treaty sale. So it would be between a buyer and a seller. You'd go out and contact them either with a buyer's agent, or you'd contact them personally, or they'd have a seller's agent that you could contact, and they would basically tell you this is the condition of the house. Like, you'd have reports about plumbing, electricity. You'd know about the structural integrity of the place. Whereas now, or more recently, so say between 2013 and 2018 especially, or 2017 especially, you had, in Australia, it was almost exclusively auction sales. And you'd get auctioneers that would go between 5 different places on one weekend or on a Saturday to then sell one place to the next place. And they spent probably half an hour there. They had no idea what the actual house was like. They know the area, maybe. But like, that's basically what was happening. You didn't really have a good understanding of what the condition of the house was.
When I bought my house, I pulled comparables in the area. I saw sales values in the area.
See, to do that in a market like Sydney in, say, between 2014 and the end of 2016, by the time you tried to do that, the house would have sold. Right. And that's the thing that people were like, oh, I've got to get in now because the house that I want to get is just going to be more expensive every time I try and buy it. Sure, but can you service the debt? I don't care whether or not the house you want to buy is more expensive, because the question is, if you can't service the debt, is the person that's buying it also going to be able to service the debt? And if the answer is no on both accounts, then what the hell are you thinking trying to get into the market in the first place?
Exactly. Thank you. That was probably one of the highest points in this conversation.
Doesn't make sense to get into the market in that regard.
Okay, I got one here from Orlando, Florida. Why is the stock market freaking out?
Why is the stock market freaking out?
Yeah.
The two main reasons are because they can't be sure of what the fiscal policy is, so what the government policy on expenditure is going to be, and monetary policy has been going one way for a long period of time. So there's not really any. It's all headwinds in terms of what's happening in the market. So there's not really a whole lot of positives to say that it's going to keep going up. Like, people are borrowed to the hilt to push the market valuations to where they are now. And there's not really any reason for them to be where they are at the moment anyway. Like, I thought they were high in 2015, 2016, and they went, another 40, 50% higher in terms of index. So they went way higher. But it's a question of, does this valuation make sense? And it hasn't made sense probably since, I don't know, maybe 2015. But there was still ability to borrow, or there was still ability to borrow and refinance existing debts in the corporate wholesale finance market, and that's very difficult to do now. Like, you can't. There's a whole bunch of junk bond issuance that are just going to be treated as trash. Like, no one's going to buy them because you can't even price them. Like, these things originally they were all the junk bonds that were being issued between, say, 2014 and 2016. The U.S. Treasury would just buy them, or the U.S. Federal Reserve would buy them, and they'd guarantee liquidity to whoever was issuing this crap, and they could just do whatever they want, basically. Now, the fact that they have that on their balance sheet and they're going, well, we don't want this anymore, we're going to offload it.
Right.
There's already shit that's coming. Like, people know the things that they issued were garbage, and it's going to be, like, either not renewed by the Fed or it's going to be sold back. And everyone that issued it goes, well, we already know that's crap, and we're going to try and have to put more crap into the market, and the Fed's not going to be a buyer. Like, they're a buyer of last resort, but they're only a buyer of last resort in a situation where you get to a financial crisis.
Right.
and we're not in that point yet. So it all
Okay.
basically comes to that.
I got a really good question here from a Mark Oliver, and he's actually based out of Iceland.
Yeah.
And the question he's asking is, what is the great show? Blah blah blah. Goes into thanks. I watch you all every day. We're getting coffee. Blah blah blah. Then it says there's a question right here. What is what is a key factor in when trying to time the market?
One of the biggest ones I find is still that amount of cash left on the sidelines. So if there's no cash left on the sidelines, you basically, and that's roughly 10% of cash allocation is it. Oh, sorry, of money allocation is left in cash. The rest of it's in equities, bonds, etc. If almost all of your money is in cash, if almost all your money is in the market, then a pullback becomes a crash because you've got no money to buy the dip. Like everyone says, oh, just buy the dip. But you can't buy the dip if the people buying the dip before were just borrowing to buy the dip to then push prices up.
Mm-hmm.
That was basically, there's a term called the Fed put, which is where every time there was something like that, the Fed would just print money. There'd be a quantitative easing, and then the market, when it looked like it was about to crash, would just keep going back up.
Okay.
And that was like classic 2016 that happened. Like early 2016, it looked like the market was going to crash. Crude oil was trading $28 a barrel. Those sorts of things were the case. China's stock market had just crashed, and the Fed came in and printed money. So I think that that's one of the big things. Timing the market for the bottoms. The bottoms, you're usually looking for a combination of unemployment peaking and then lowering. You want private credit to bottom and then go up,
Right.
or the rate of private. So if you've got private debt going up really fast and then it starts coming down, and then the rate at which it starts coming down slows down, then all of a sudden the credit accelerator, so the rate of credit acceleration, starts becoming positive.
Right.
And that's when money is starting to come back in the market.
So
You'd
that's
also
when it's
see
a good time. So when you see, let me get this straight. So when you start to see more, I guess, liquidity or more money coming into the markets, it's a good time to jump on the train.
Yeah. So if you're trying to time it, like if you want to get in when the liquidity just comes back, and you want to get out when the liquidity starts to dry up, then you can do that all the time. It's not very difficult to do that. There's a bunch of different ways. Like if you're buying equity with no leverage, but you're buying it when volatility is like 80 or 90, you're probably going to be in a position where if the company survives, and that's a big if the company survives, then you're going to make a lot of money by buying it.
Right.
So you'd be looking for, say, at the moment, you'd be looking for a company that you think is going to survive, but it's going to crater in the short term. Whereas if you're looking at the bottom of the market, you're looking for, so like you can either short the market in a situation where there's a bunch of rate rises and all the money that's in the market is just based on share buybacks and all your liquidity is from that.
Yeah, we talked about that at the beginning of the show. People, share buybacks, guys. If you're just tuning in late into the show, look at the beginning. Scroll back. Don't be shy. Watch us from the beginning. We did discuss rate buybacks in depth. Kind of important that you understand how that's creating a false market, I guess, if you want to say it that way.
Well, it's showing you something in the price that's not occurring in the open market, apart from like hedge funds have largely left the market. Like they're net sellers, not net buyers. What do you call it? Also, retail investors are up until, I would say, early 2017, they would have been net sellers and not net buyers. There was a little bit of a shift in that, but it's gone back to being net sellers and not net buyers. Those sorts of things don't get reflected when the price just keeps going up, because the price is getting bid up by companies buying their own shares back.
Mm-hmm. Mm-hmm. Yeah. That's
and
kind of
look at the incentive for why they're buying their own shares back, which is total shareholder return. Therefore, if 3/4 of your short-term variable remuneration / bonus is being paid based on how much total shareholder return there is, then you're going to want to make a bunch of share buybacks, because the share buybacks push up the price and you don't have to get rid of any of your profits.
I just think that's very dangerous.
Well, of course it is. Of course it is. Well, what you're doing is you're flying too. It's the Icarus market. You're flying way too close to the sun, because all your profits are not being reinvested. They're just being put into buying the company back, which is financial engineering. It's
that's
not.
Why I call them empty shells. They're empty shells. These.
Well, they call it financial engineering when instead of delivering genuine value or delivering innovation, you start delivering share buybacks and corporate note issuance and all those sorts of things to try and bolster your numbers. So your EBITDA looks really good, your profits look really good. And then after a while, you start using things like non-GAAP accounting metrics, so non-generally accepted accounting practice metrics. You start using that to say, this is why the company's going to keep doing this, even though you might not be generating profit or your profit margin's tiny, like in the case of Amazon, where you're just losing money to gain market share, and then eventually you have no competitors.
That's yeah. Okay, I got a question here from Todd Terry, who is from Phoenix, Arizona, just outside of Phoenix, Arizona. Says, hey, Mike, I've been watching your channel for like 5 years now, and the first time I'm sending you a message, I want to ask a really serious question. How and what is the best way to protect my portfolio from the debt market upheaval in 2019? What should I do to...
So you can always buy options. That's one of the easiest ones. If you have... It depends on what your exposure is. So if your exposure is to individual companies, then options is probably the easiest way. If your exposure is to an index, then you can buy... you can basically buy a bunch of ETFs that are short, so short ETFs. But again, with those, you have management fees, and it's very difficult to get an ETF that's one-for-one matching what's happening in the market, because they'll say, oh, this is a short ETF of the SPX 500, but they have to re-weight it every day, and it's very difficult to match the index because those purchases were made at a certain point in time. And if you haven't made it at that exact point in time, then there's going to be gaps between what the ETF says is the price and what the index says is the price.
Because what we're seeing right now is almost half of the stocks in the S&P are in a bear market. So
yeah, so there's a really good indicator called the advanced decline line, which shows you the net number of positive and negative companies in each day of trading. So at the close of trading, you'll have this many companies up, this many companies down. So I like to do that on both a week basis and a daily basis. So I'll look at both those indicators, and then I'll combine that with volatility and then the index itself, or whichever index I think is representative of the market. Those three things are really good. So if you're looking at advanced decline, both on a weekly and a daily basis, you can see, so there'll be trends that emerge in those. So if there's a gap, if there's a large divergence, so if the advanced decline line starts going down really heavily, where it becomes heavily negative and the index is going up, it means that's probably a pretty good time to sell. Or like that's basically an indication that the market is wrong, basically, because the advanced decline line almost always leads the index. So the S&P 500 and the Dow Jones both get led by the advanced decline line of the overall market.
Okay.
Because with the way that I'll just finish quickly. And with the way that the indices are calculated, they're market cap weighted. So you could have 3 stocks that are really big companies and they go up, and then you have 20 companies that are lower market cap and they're all going down, but you only focus on the 3 companies that are going up because they drive the overall index higher, even though most of the rest of the companies are going down.
Right. It's a way.
So you need to look at market, right? Like they call it market breadth, but yeah, it's worth noting, if there's only 3 companies going up, it's not really of much use to anyone that doesn't own those companies to look at the index, because everything else is going backwards.
It's like when they take the benchmark average of the whole country as a whole. Of like for example, for Canada, they would look at the benchmark price across Canada for the average house. It's super high only because Vancouver and Toronto are propping it up. So it
But
makes
you've got to look at, well, again with Vancouver and Toronto. First of all, what percentage of the entire market capitalization of the total housing stock do they make up? Second of all, how many dwellings are there in Vancouver and Toronto versus the rest of the country? And third of all, what's the population there versus everywhere else?
Right.
So obviously Toronto and Vancouver have got the largest population. They probably have the largest amount of housing stock, and they're probably the housing price. Yeah. So well, it's debt to income. When you start looking at Vancouver, what is it, like 250% or something like that?
Yeah, it's nuts. I don't know if you saw that one
Well,
where
nationwide in Australia, it's 190%. So I'm assuming Sydney would have to be 260, 270%. It'd have to be something like that.
this is ludicrous.
But that's average, though. There's some people, there's like 30%, 35% of the market that has no debt. So it's more like 400, 450% when you start looking at the people that actually do have debt. It's massive numbers.
Okay, I got a question here from J-Man from Atlanta, Georgia. Is the bond market sending us a signal to go with should I go with a variable rate mortgage?
So that's a really good question. Again, first of all, you need to know how big your deposit is. If your deposit's large, you probably want to go with variable because you can go to a bank and refinance, right? So if your deposit's 50%, or if you have 50, 60% equity in your house, and you have a mortgage at present, then they're probably more likely to give you a refinance loan on a lower interest rate than what they are on new borrowers to try and get into the market, because the new borrowers have got a low deposit, a small amount deposit. That's what I'd be talking about. So it's the same situation in Australia. If you have a deposit of 50%, then the banks go out of their way to try and get your business. If you want to try and refinance, they'll give you a cheaper deal to refinance the mortgage that you have on variable rate, or you could have a 2-year fixed or whatever it is. Whereas if you're going in with a 10 or 15 or 20% deposit, they're basically like, well, we don't want your business, or if you do want to get a loan with us, you're going to have to pay a really high premium in interest rates. Okay. So that would depend largely on how much, first of all, how much the deposit / equity is, and second of all, what your income is. Like, can you service the debt, and how much do you have in assets, all that kind of stuff. If you've got a massive deposit, then yeah, variable. If it's not a massive deposit, then you want to go with a fixed rate.
Okay, so I got, let me go over to the comments here in the chat. Let's see if we got anything here. Peter, or I don't know if you know Oetzinger, Peter Oetzinger. He's our guy from Sydney too, or I don't know if you've seen him on the show or heard him on the show. He's, we'll start seeing him just like we're seeing you now, so we could actually put a faces to these voices. And he talks about gold and silver and hedging against, buying rare coins, staying away. I personally stay away from
rare coins. I see there's a large difference between rare coins and gold and silver, because gold, if you're buying a bar, then you're buying for the market value, or for the resale value. Whereas if you're buying a coin, you're buying something for its rarity, and they're two very different things. Like, that's not, they're similar, but I don't think they're the same.
I know what you're saying. It's the rarity and how many coins are printed and minted and blah blah blah. Yeah. So
it's like saying that, oh, I have a kilo bar of gold. So, it's worth what, 20, 30 grand. But I then say, oh no, but I have 3 Aurelius from Roman Empire that's 2,000 years, 3,000 years old, or what was Aurelius was like just before the turn of the first millennium. So that coin is worth like £20,000 in British pounds. So if we were to buy it, it's like $30,000, but the coin weighs like, maybe an ounce, not quite an ounce, but it's the same value as a kilo bar. So it's not a one-for-one thing. You need to say, oh, it's this level of rarity, and the percentage is what 99.9% or whatever. There's a whole different gradation and things like that. So you need to be very specific with
Right.
describing what exactly you're going for.
Okay. Okay. I got a question here from someone from Alberta, who's an
Yeah,
actual works at one of the sites. He's actually a project manager on one of the oil companies. He says,
yeah.
oddly enough, Mike, I am a project manager at one of the companies you mentioned once in a while on your channel. And what does Canada need to do to fix this dysfunctional oil market? It needs a long-term fix. Canada's very dependent on this. What
I think you need to diversify your economy away from things that aren't going to make you money, right? So Saudi Arabia, the US, Iran, Venezuela, they're always going to be able to outcompete Canada because of the difficulty of extraction. Um, of the extraction process in Canada is vastly more difficult than what it is in the Permian Basin or in Saudi Arabia. Like, you're not going to be able to compete because it's a high quality product you get out of the ground. And there's nothing, it's like saying, oh, I'm getting iron ore that's 10% out of the ground in Western Australia. Or if I go 20 kilometers away, it's 62%. Like, how do you compete with that? It's just what you get out of the ground. Like, that's what my thought process is. Like, I'm not against mining per se. I'm just saying, doesn't make sense for it to be the basis of your economy if it's not going to be competitive,
right?
right?
Yeah,
Like
we,
the
we
oil
talked about
markets are
this a
basically,
few weeks ago.
yeah,
That's right.
yeah.
Okay,
But again,
so
like there's a lot of automation that's going on in these mines as well. Like I have a friend that I spoke to a few days ago, and she was saying to me that they got their truck automation time. So they're retrofitting these tools to large scale cat trucks. So like your massive trucks that are carting several hundred tons of iron ore out of Western Australia. They basically, it used to take them a month to retrofit automation onto their trucks. It's taking them a week now. So once you've retrofitted that truck to be automated, that's the truck driver's job is gone, right? So that's something to me that I don't think has been fully appreciated in mining infrastructure. We hear people talk in Australia all the time about, oh, we need to get mining jobs. Sure, but the mining job is going to be paying some mechatronics engineer to retrofit existing trucks in a week that then gets rid of the truck driver. And then there'll be a bunch of other processes that are just end up getting automated.
yeah,
So you won't actually have jobs. It'll be a contract for however long, but once that job is done, it's done. Like you don't get the job back from that. And I think people need to understand that you need to have other sources of revenue in your economy, not just this particular thing. Because if it can be automated or if you can be outcompeted, there's not really that much point to it. Like you might get an income for a little while, but who's going to use this? Like if it cost me $20 per DVD to buy a DVD from Blockbuster or to rent a DVD, it cost me $6 a DVD, and then I go on Netflix and it's $13 a month and I can watch 300. Who am I going to go with? Like,
can you do 300 in a month? Can you do 300 in a
easily.
month?
Yeah.
You could do 300 movies in a month.
Oh, like like a TV series. So
I
what's
know.
that? Like
I'm just
you could binge 50, 60
I'm just
in a
pulling your
week
chain.
easily.
I'm pulling your chain. Okay, let's talk. I want to talk about a little bit about food because I've had a lot of people message me, email me, even message me tonight saying that the in their area, especially people in Canada, have been messaging me, and people in New Zealand have been messaging me, telling me that the price of food is skyrocketing. It's beyond.
Yeah.
I had someone just comment right now in the comment section that a gallon of milk is $7 now. So.
What's this? A gallon of milk, $7.
Yeah. So like a jug of milk. I when I lived in Vancouver, it was so expensive. I would go grocery shopping. I would prepare $400 for the week because
Jesus, that's
Yeah.
expensive.
So what is going to happen with food? Because food, I mean, without food, we're not going to be here.
Yeah, I think people discount agriculture and innovation in agriculture which you need to decrease the cost of food. I think people should also try and grow their own things. Like if it's herbs and things like that, they should actually try and grow their own stuff rather than buying it. Like basil, mint, those sorts of things should be grown at home. You shouldn't try and buy them. But again, it's going to depend on the environment you're living in. Like if it's New Zealand, then a lot of the food produce, apart from, I don't understand why milk would be expensive in New Zealand, because they've got one of the largest dairy farm outputs per capita in the world. So
I'm not saying New Zealand milk. I'm saying somebody from Vancouver commented saying that in Vancouver a gallon of milk is $6-7.
That's crazy.
And
in Australia, you probably pay $3 or $4 for that in Australia.
Right.
In the city in Sydney.
I can attest to that because I know, and I lived in Vancouver, and you got to prepare. I made a video about 3 years ago on my channel, and I looked back at it the other day.
I think a lot of that would actually have to do with the cost of servicing existing debts on the businesses that actually provide the food in the first place.
Right.
Like, because if they've got to pay a certain percentage of whatever their profits are from what they sell, it's just this whole idea of rent seeking, which is extracting profits from the sale of something. If it costs you a lot more to do that, then obviously you're just going to try and pass the cost on to your consumer, and eventually you won't be able to do that because they just won't buy off you anymore.
Right, exactly.
Do you have like a series of oligopolies in your supermarket space? So, say for example, in Australia we have Woolworths and Coles are the two main ones. Like you have Aldi, which is a foreign competitor, but it's usually Woolworths and Coles are the two main grocers in Australia. Would you say you have a similar situation to that in Canada or in?
Well, you see, in Canada there's a bit different.
I know it's similar in New Zealand because I've been there, but I haven't been in Canada as long as what I've been in New Zealand. So, like, I've been in Canada for like 2 weeks, so I wouldn't know to the same extent as what I know in New Zealand because there's a lot more.
With what's happening here in Canada, what I notice is a lot of people are turning, especially myself living now in the country, I just turned to farmers markets.
Yeah. Do you find it's cheaper?
It's cheaper and it's all grown, homegrown. I buy local jams. I buy eggs. Oops. I buy milk. I
think that's good because like if you're able to go to a farmer's market and it's cheaper, and you're supporting a local business, do that. Like don't go to some grocer if it's going to try and rip you off because they have an oligopoly or they have the control of the marketplace. Like, what's the point?
Yeah, of course, because you walk into one of those big supermarkets, a lot of people think, wow, look at all these companies here, all these labels. It's only 3-4 companies.
They're monopolized. It's not a monopoly, it's an oligopoly. You have 3 or 4 large competitors, and everyone else takes up such a small slice of the pie that you're basically trying to have to deal with whatever's left as market share between these really small competitors, and they end up going out of business really quickly. So if you can support your locals by going to a farmer's market, then I would definitely do that.
Yeah, farmers markets are all over the sides of the road here. I pull over, and then there's like 3 butcher shops in town, and you could even watch your cow get chopped up if you want.
Yeah.
So for me, I'd like to eat the hamburger. I don't want to meet the cow, but
yeah,
you know what I'm saying. But
well, there's a whole like farm to table movement going on where everyone's like, we're going from this point. There's no like in between, and I think that it's a good way to make sure that the money that you're spending is actually going to the people that produce the goods, so that they don't have to suffer to try and just make ends meet. Like in Australia, there's a massive drought that's been going on for a period of time, and it's definitely made produce more expensive here. And we're the food bowl of Asia, so it's probably made food everywhere else expensive as well.
I got one guy, James, here. I actually want to say, says Mike, did you know there is no profit on milk in Canada? I am a store owner, and now for decades, it's been sold at cost, and places like Walmart and Shoppers will sell it at a loss these days.
Low cost. Yeah. So because they're trying to gain market share, that's what I thought. So you've got an oligopoly of really large producers that can afford to sell at a loss to try and put their competitors out of business.
That's
In
bad.
Australia, I think in Australia the cost of a liter of milk is about $1. Right?
Okay.
So for a gallon is like 4 liters, right?
3.5 liters.
3.5. So yeah, that'd be like $4 here. But we have one of the largest dairy industries in the world in Australia. Like us in New Zealand are massive. There's a company called A2. There's A2 Milk, and almost all of the. So you've heard like the whole baby formula issue. Do you have that in Canada?
Yes,
Yeah.
yes,
So
yes.
where there's like Chinese buyers that will go in. A lot of that has happened in Australia, but it's purely based on the scale of our dairy industry, and the fact that they don't really have a reliable source of food in China. And I think there's also like marketing strategies, and there's been issues with food supply there. So that probably the scarcity would definitely jack up the prices.
Mm-hmm.
And I think again, things like free trade in areas that have got a surplus
Mm-hmm.
end up making the cost of the food everywhere else more expensive, which is, it doesn't sound right, but all you do is you take from the place that's already got too much
Right.
and you put it everywhere else. But you do it at a premium because you wouldn't want to sell at the same price as the place that's got a surplus of the food.
That's right.
It's like, it sounds like 1741 France all over again.
Oh.
You start looking.
Yeah, we talked about this the other day too.
Yeah.
Yeah, we actually talked about that the other day. So I got somebody, James, in the comments again saying that comes from a dairy supplier and the government pays out to help the industry. The retail stores
Yeah,
make
so you have
zero on the
subsidy.
milk, have for many, many years. Just have it because it's a staple.
Yeah.
Wow.
But it's like, I think that's, so the thing in Australia is that our grocery stores set the market price. So they might be paying, they'll probably pay the dairy farmer 20 to 30 cents a litre and then sell it at the market for $1.
Mhm.
So, or maybe less, it might be even less than that. But the problem in Australia is not that the farmers aren't being supported, it's the retailers,
Mhm.
and they're trying to cut as much profit as they can because both Coles and Woolworths are listed. Like Woolworths is a listed company, and Coles just demerged from Wesfarmers, so they're their own entity now as well. And again, you've got a bunch of board of directors that want to make as much profit as possible because the total shareholder value, total shareholder return determines their bonus at the end of the year. So, like, these social issues are coming from financialization.
Yeah, they definitely. Well, obviously, it's like you said, financial. What would you say it was called? Financial
Engineering.
engineering. That's it. It's for
Yeah.
uh,
But I think financial engineering is it's more like it's more like when a company can no longer innovate or produce something of value and they have to try and make sure their profits are delivered some other way,
right.
whether that's creative accounting or it's so either creative accounting or they'll do a bunch of different financial
Macro.
yeah, well, it's basically, so they'll say, oh, we want to issue this bond at this rate so that we can arbitrage it. So they start playing games in financial markets instead of actually innovating.
Okay.
Like, one of the companies that I'm really happy hasn't been listed is Dyson. You know Dyson, the vacuum cleaners and the
Mhm.
hair dryers, and I'm really glad that they haven't listed because they are able to focus on their long-term goals and actually produce products that are going to work for a really long period of time.
Right. Instead of this Mickey Mouse stuff, this Mickey
Well,
Mouse.
yeah. When you start just going, oh, we want to produce this to make a profit, then all of a sudden the quality deteriorates and the innovation doesn't exist. It's not there anymore.
Well, that's what happened with Mercedes and Porsche, and a lot of those companies started catering to middle class, and then look what happened. The quality of the product went down unless you start spending more.
Mercedes is still good, but I think it's you have different lines of vehicles,
right.
and
I
also
know.
with Mercedes, you get massive government support for those manufacturers, which you don't get as much of out of the rest of the European Union, which you definitely don't get it. Well, you don't get it in the US. So, well, you did. Like, you got bailout money for GM and Ford and things like that.
Bombardier.
But Bombardier is one of the Canadian manufacturers. I don't think it made sense for Bombardier to be an aeronautical manufacturer, and it hasn't made sense for them to be that for a very long time.
Yeah.
Their government's basically stepped in. But again, shareholders wanted to get a return out of it. Like, Bombardier is listed in Toronto, I believe. So it's this whole idea of we're going to get this return because we've put money into it. But it's not like we've put this much money into training our engineers to try and think of innovative solutions. We've put this much money into financializing the company.
Right.
So, like, I come from an engineering background, so I kind of have an idea of where the money needs to go to try and actually improve the company or improve the output. Okay. Because it'll either be your modeling processes, so the way that you model the car, you could be doing things like using LS Dyna to simulate crashes and things like that, see what their safety is before you even start manufacturing the car itself. So the capital spend on something like a supercomputer or a high performance computer, or even leasing high performance computer time to then test how this car would perform in a certain road situation before you start building it. Right. That's not really something that gets done, except for in countries like Germany, where there's a continual spend on research and innovation in automotive manufacture. So it's very difficult for anyone else to compete with them because they're spending their money in an effective way.
Yeah, of course. Yeah. It just coming. Your words are just falling into my mind as you speak, and it's all making sense.
Yeah.
Okay, guys, we are approaching like an hour and 40 minutes. If anyone has any other questions in the comments, or if you want to send it on Skype, or you want to send it through Facebook, or the way you've been sending me these questions, I will be more than happy to ask them. And Andrew Baker here, 2-time world champion on the show. And really happy to have him here to give us an insight on what he thinks is going on Corner Market Watch. Guys, let me know in the comments below if you're watching this on replay. If you want to do once in a while, we'll have Andrew on when he gets a bit of time, maybe once a month if he's got the time to do a Corner Market Watch and just give us an update or an insight on what's going on. See, right now he's looking at his stocks because it's daytime there, right? So,
yeah.
So he's watching his stocks right now as we speak, and looking at where to go and where to invest in, and looking for the bottom. So
we're nowhere near the bottom. We're nowhere near the bottom.
Okay, we're nowhere near the bottom. So yeah, okay. So that's good to know. Someone's asking me, Mike, do you have metals in your portfolio? Andrew, same question. Yes, I do have physical metals in my portfolio.
Yeah, I do have a percentage of metals, but I don't try and make it my main holding.
No, me too.
I prefer if I think I want to get exposure to metals, I'll generally try and find a mine that's just made a discovery as an equity, but there hasn't really been that much of that. So I do have a little bit of physical metal.
Okay.
Apart from that, but yeah, they're the two ones.
Okay, somebody's saying here, where'd it go? Where'd it go? Oh, do you think the ASX will crash?
Yeah. Yes, I do. Well, it's basically inevitable. Like, a lot of the money that's in the ASX is in either self-managed super, and a lot of the capital is tied up between banks and miners, right? So 30% of the Oz 200, roughly by market capitalization, lies in the big four banks, plus Macquarie Bank.
Okay.
So you start talking about 30% of the market, and all of those banks are heavily exposed to the housing market. And our housing market is one of the most overinflated in the world. Like 60% of all loans, mortgages or residential mortgages, 40% of them by the end of 2014 were interest-only mortgages. You
Oh,
have
those are
banks.
coming up to fruition for refinancing.
Yeah,
That's
so
going to be very interesting next year.
it'll be the end of 2019 to early 2020 when refinance activity starts to peak. You already have a bunch of people being rejected for refinances. I think the rejection rate is something like between 40 and 50% of all refinances are rejected. So it's a very, very high rate of rejection. So I think once the market starts to really come back down, due to a combination of the fact that a lot of those interest-only loans were to investors and the fact that they're falling in price, they now can't refinance. They have to sell. They have no other option but to sell. Otherwise, they either have to cop the loss or they pay out the mortgage in full.
Okay. And then
There's a lot of people, because if you can't refinance, you basically have to sell.
Okay. Low Roller Scratcher asked this question 14 times, and I'm going to tell you. I'm going to tell you what he's asking. Andrew, have you invested in Bitcoin? Is it a good time to buy Bitcoin?
No, I'm not invested in Bitcoin. I was in the past. Like I bought Bitcoin, Ethereum, Ripple. What else? There's like 10 of them that I bought, but I bought them in late 2016, and I've offloaded them pretty late last year. So there's not really, to me, again, it's depending on how much you can borrow, and that whole amount, that borrowing capacity was wiped out. Like, it's universal. You start looking at markets like January, February is when all the liquidity started to dry up. Like the top of the market was pretty close to the end of January. Like right. August was just a little bit higher than what it was in January. So if you had gotten out of January, you pretty much would have been the top of the market. And that was the same time as when the cryptocurrency market topped out. It's just the only difference has been that Bitcoin isn't the company that can buy back its own shares.
Yeah.
Right?
Right.
So there hasn't been that same impetus to do that sort of thing. And there's not the same level of financial engineering in that market. It's much closer to pure speculation than what the rest of the other markets are, because you don't know what the utility of these things is going to be at scale yet. Okay. It's very hard to say what public blockchain technology is going to be as a utility in the next. So it might be worth a lot in the next 20, 30 years. But at the moment, I'm looking at global credit supply, and it's one of the most vulnerable to that. So a lot of the money that came in to the cryptocurrency market was institutional investors via things like fintechs and startups and things like that. So a lot of that money is very speculative. It's VC money. Right. It's not Warren Buffett's or George Soros is coming in and saying, we're going to invest in this for the next 30 years, right? Mm-hmm. Because if that was the case, then you would see there'd be a vastly different market outcome than what there is right now. Like it would have bottomed and then quickly gone back up. So I don't see that kind of investment happening yet.
Right.
When it does, I'll be the first person to put my hand up and say, yeah, I'm interested in buying this, because.
Well, can you keep me on the pulse?
Yeah, for sure, definitely.
Keep me on the pulse, buddy. Okay, we got so many people in the comments here. So guys,
the other really big thing I would say with the cryptocurrency market is the net profitability of mining. So a lot of people don't look at how much it costs to mine in terms of your energy costs,
right,
in comparison to what you pay for the token, right? Mm-hmm. So if you're making a net loss by mining something like that, it defeats the purpose and the mining complexity goes down. So you have fewer market participants, and the network effect ends up happening in reverse.
Right.
So, yeah.
I see. Yeah, exactly. Yeah, but it's also hard to manipulate crypto markets in a way where, because...
I don't know if I agree with that.
Well, I know, it's all electronic. I mean, all you have to do is push a few buttons. Someone somewhere's got to push a few buttons somewhere.
No, but it's a different type of manipulation, though. The manipulation is, I own 60% of the market, so I'm just going to keep doing this to try and push the price down and acquire it off people cheaper, and then push it up a little bit. because that was what was happening. You had wash trading, was going on all the time in the crypto market. Like if you look at places like what was it? Not Bit. So in places like Bitfinex, right? You had a whole bunch of wash trading where people would just buy something, and there'd be massive buy orders, and then all of a sudden they'd deteriorate, and there'd be really small buyers that tried to jump in on top of the buy wall, which is where there's a massive buy order because the person's got a whole bunch of cash to buy, and then all of a sudden they'll push the price down 10 or 15%, buy it all back up, and then keep doing the same thing over and over and over again. They just keep washing out these amateur traders, and they lose their shirts, which is, it's not very. It's illegal, but it's very hard to police in things like cryptocurrency because the markets are operating 24/7 around the world.
Yeah. Okay. Anyways, we're approaching our second hour here, and I gotta hit the bathroom. So, I think you've been drinking a lot of water. I think you gotta hit the potty.
No, I'm good. I'm good. It's just a bit hot. That's all.
Turn on a bit of the. Don't you got an air conditioning there?
Yeah, I turned on the AC a little while ago, so I'm fine.
Okay.
But,
yeah. Well, yeah, we're approaching our second hour, guys. So we're gonna keep. Someone saying Mike is drunk again, guys. No, I'm not drinking. I haven't drank since last time we talked on the Mike in the Night. So. Okay, so anyways, yeah, we're just going to cut it off here for now, and then if you guys in the comments section, Andrew's going to keep us on the pulse with his channel, hopefully launching in January, February of 2019, and we'll continuously plug him on my channel and get him off the ground. Yeah, I just wanted to thank you for coming on and taking the time to educate us, because most of us were being educated as we go along. A lot of us don't want to wake up to a crash course in why we did the decisions we made and like, holy crap. A lot of us kind of want to ease into what's going on.
You need to be really transparent and honest with yourself, because otherwise you're just going to keep getting hammered and not know why.
Yeah.
Like, I like to know why. If I made a mistake, I like to know why. Like, I'm not perfect when it comes to markets. No one is. There's not one person in the world that can ever make the claim that they've been right in 100% of the cases, because no one is. Like, there's uncertainty all the time.
Oh, of course. And that's what makes life interesting, because you're always entering the unknown.
Yeah, definitely.
Okay. Well, Mr. Baker, God bless you. Thank you very much for taking the time to be with us. And yeah, well, whenever you want to come back, we could do a market watch, corner market watch, and see if it picks up any steam. And then hopefully we could get your channel off the ground soon.
All right. It sounds really good to me.
Thank you, Andrew, so much.
Thanks for having me on.
God bless you.
No problem.
Okay, bye.
Yeah.
Okay, guys, so that is my man, Andrew Baker, and signing off now, it is I, Mike Martins. Have a good night, and thank you for tipping me in the tip jar. It means a lot to me, and don't forget to spade and neuter your pets.